Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Friday. It's May 12th. It's about 7:38 in the morning. The market's going to gear up to open up in a little bit less than 2 hours, about an hour and 52 minutes. And as you can see here, the market is up pretty good right now. The Nasdaq, the Dow, anything about 120 up is beyond random. But again, with the volatility being about 400 points a day on the Dow now, three to 500 points on the day, taking 108 and 20 points one direction or the other, we have to take with a big grain of salt. Now, before we get into the nitty-gritty and the review for the week, I want to show you what algos have been up to. This is so predictable, and this is something we've seen before. Now, look right here. See how it takes us out, and it looks like it's going to move in the right direction, and then it huffs and puffs for a few days, and then it comes back down. And we've seen that again right here. See that right there? Kind of huffs and puffs and goes down for a few days. These are algos. These are algos trying to manipulate the market. They can't really manipulate the entire ETF. This is a big ETF. There's a lot of stocks. But what they can do is they can wait till the asset is near the turning point right here, say around the 151 level, and they can drive it up about 50, 60 cents, which is what they do. They just trigger all the stops right here. And then once they trigger it above the resistance level, there's a lot of buy stops that get triggered here, and that causes them to get a really, really good sell price, and then they take the market down. And I'm seeing exact same thing yesterday. Because here's the thing. The technology sector, it's not really ready to move higher right now. There's no major catalyst for it. Earnings are behind us. And most importantly, all of this is large cap, and there's really no reason for this to break out right now. Now, I know that there's a thing about interest rates going lower, which is a fantasy. I think they're just going to stay where they're at for quite some time. And this is what you got to be really, really careful of. Be really, really choppy. You see that happening in the bond market a lot too, to the downside, like right here. They take you down, they trigger it, and then they take you back up. They take you down, they trigger it, and they take it back up. They take it down, they trigger it, and they take it back up. So be really careful when you start seeing these little baby moves outside of the range. Back in the day, if there was a support line right here, like this just got triggered a little bit right here, but if there was a support line, the odds are it would stay near there, but not anymore, just like this. They can't firepower an ETF for 4 or 5 days like they can a small stock, but they can drive price just a little bit above the levels to just enough to trigger buy or sell stops, and then they take it the other way around. And we've been seeing that more and more and more throughout the years. So be very, very cautious. Now, with that in mind, let's get into the analysis. But one of the reasons why you want to be really careful and you want to give a trade, you want to wait for it to be, if you're trading breakouts, which I don't trade, but if you're trading breakouts, what you want to do is you want to give the trade a little bit of time to breathe at around the new level, maybe 2-3 days, and see if it goes higher, if it continues momentum. Don't get in right when it triggers. And that's another reason why we don't use stop losses anymore, physical stop losses, because you'll have a trade, let's say you're short, you got short right here, it goes against you, you think it's going to stop right here, it triggers right here, and then it takes you back down. So we've been really, really cautious with using stop losses and buy stops for that reason, because algos are getting really tuned in to where folks are putting these sell stops and buy stops in, and they're triggering them like there's no tomorrow, like hotcakes. So you got to be really, really careful. That's one of the major structural changes I've seen in the market over the last couple of years. Now, let's get into today's analysis. Now, one of the things that is not good for the market, and this is I've been talking about this for quite a few weeks now. Back about a year ago, over the last year, when the economy was getting really, really nasty, employment jobless claims were right around 200,000. Right now, they're at 264,000 and went up again. This is very bad. This is bad because one of the tools that the Fed has been using is economy can sustain higher interest rates because the jobless situation is under control. Well, it looks like it's finally not in control. We went from 200 to 220 to 240. Now we're at 264. So that's a major issue. Remember earlier this year I was saying how 4-week moving average is around 200,000, 220,000. It was very consistent. And Squirrely, Mr. AKA Squirrely Powell, was saying, hey, if this continues, we'll be in good shape. But look at it now, 264,000. That's a big, big jump. So something we have to be very careful of, because if unemployment has been strong employment has been holding the economy together. If it wasn't for the employment, they would have to be a lot more cautious. But now they may have to be cautious. Now, you know how the Fed says we're not going to raise rates anymore? Well, I think they're not going to raise rates, not because what they're doing is working. If it is working, it's working really slow, really, really slowly, like way too slow. He should have started a year earlier. But also, if the jobless claims start getting out of whack, they're going to have to be really careful. So the way I see it, they're going to have to be really, really careful, not because what they're doing is working, but they're going to slow down not because what they're doing is working. They're going to slow down because the economy is actually getting worse, and it looks like it may be dipping into a real recession, and they can't do anything to stop it, and they can't raise rates going into a recession. So we got to be really careful. Now, the PPI yesterday came out better than expected, but look, they were expecting 2.5, they got 2.3. Food and energy, they were expecting 3.3, they got 3.2. Remember, these numbers can be revised over the next 60 days, or 45 days. So these are not final numbers. And yes, it does look like the PPI and CPI is getting better. But if that gets better and unemployment gets worse, it's not going to be a good position. Now, let's get into the nitty-gritty and talk about what happened and what we can expect to happen today in the market. So U.S. benchmark indices closed mixed as renewed concern about health of regional banks, which is not going away anytime soon, overshadowed economic data that showed a moderation in PPI and signs of a cooling labor market. In Thursday's session, the tech-heavy Nasdaq 100 outperformed the major benchmarks, helped by a surge in Google. That's what drove the market higher. And a lot of folks are seeing seeing XLK, the technology, consumer discretionary sector goes up, but I'm telling you, it's just a handful of stocks. The sector itself is not getting better. Momentum levels in consumer discretionary is actually declining. So you got to be careful. There's a narrowing of momentum there. The company said it would expand to use its artificial intelligence in developed conferences. Okay. JD, a Chinese stock, climbed over 7%, was it the top percentage gainer for the tech-heavy index? So that's what drove the index up yesterday. It's not a bunch of stocks. It's just a handful of stocks. Like Google has a big market cap. Banking sector worries continue to weigh on sentiment, with PacWest, sounds like Pac-Man, PacWest plunged over 22% after the bank reported almost a 10% drop in deposits and pledged an additional $5.1 billion of loans to central banks. Jamie Dimon, the head of JP Morgan, wants to eliminate short selling for the time being in regional banks, which may not be such a bad idea. That can really cause the market to plummet. Walt Disney slid over 8% because of Disney Plus subscribers. I wouldn't think that would be the case. I would think they're doing well. This is why we always get surprised. U.S. Producers Price Index fell to a 2-year low, which is very, very solid, but unemployment is at a 1.5-year high. They were expecting 245,000. They got 264. That's my major beef. And if that keeps going in that direction, unemployment, higher interest rates, people not working, that's a recipe for a recession. That's why the Fed is being so slow to raise rates. Now, the market is anticipating lowering rates later this year. That ain't going to happen, folks. So the U.S. rate futures have priced in an 85.8% chance of no rate hike. Yesterday, it was at 95% before the banking fiasco, I guess. Moreover, the probability of a 25 basis point cut at the July meeting is now at 36%. That ain't going to happen. Wells Fargo cautioned Thursday that the Federal Reserve will not cut rates this year. And I'm going to caution you right now. The Federal Reserve will not cut rates this year unless they're completely bananas. With unemployment rising, they're gonna cut rates. With earnings being downgraded for 2 years, they're gonna cut rates. I'll see it when I believe it. So there's a big disconnect between the market and the Fed right now. I think they're not going to raise rates and maybe lower rates because we're in a recession. That would be the only reason why. But I think they're just going to keep them where they're at for the foreseeable future. Today, all eyes are focused on the U.S. Michigan consumer sentiment, which will be very interesting to see. The reading is supposed to be at 63 versus 63.5. A nothing burger there, but I want to hear what Bullard and Jefferson have to say about interest rates going down. That would be the funniest thing in the world if they lowered rates. Strength in luxury stocks is lending support in Europe to the overall market, which is very good. In China, They closed lower for a fourth straight session. This disappointing trade and inflation data released this week darkened the country's economic rebound prospects. By the way, metals dumped on this because they export a lot of stuff made with metal. So metal prices are in the crapper right now because of China. And on Thursday, data showed new Chinese bank loans plunged more sharply than expected, adding more doubts to the economy pandemic recovery. Folks, they've been taking it under the chin for a long time. Nikkei, the Japanese Nikkei closed higher and hit a 1.5-year high today or yesterday as investors digested a bunch of strong earnings. And again, keep your eye out on Japan. I think the Japanese yen is going to rally again. Tesla, finally, I can probably get a short going on Tesla or maybe another stock company. I'm really bearish on Tesla and GM. I'll show you a chart in a few minutes. But Tesla rose 1% in pre-market after Elon Musk stepped down from chief executive position in Twitter. Thank God. And I'm going to tell you, I don't think he's going to be able to save Tesla. I think they're in a downward trajectory, partly because they're not coming out with any new goodies for a long time. Now you've got companies like Ford, Toyota competing with them straight on, not partly, straight on. And you don't want to compete with Ford and Toyota. It's going to be very hard to win. When they were doing their thing 10 years ago, and everybody was catching up, that was a whole different story, but those days are gone. News Corporation gained more than 3%, so the market is uppity today. So look at some car stocks. I want to show you this. Bearish. I kind of want to sell it right at the 33.93, but I want to sell General Motors. Look at Tesla. Let's see how much it's up today. Oop, this would be a good time to sell it probably. Let's see how much more higher it can go. But I'm bearish on Tesla. I mean, I'm glad he's not going to be the CEO. I'm glad he's going to be focused on less things, but he still has so many things that he's involved in that it's going to be very, very hard. And also Ford. Look at Ford. I'd probably sell General Motors, but they all are doing the same thing. They're in a steep downtrend. And all of these stocks look like they're going to be in the crapper. So car companies are not going to be doing so well. And also remember, there's an issue with exports from China. And if there's an issue with exports, they get a lot of parts. They get a lot of aftermarket parts from China. Remember how Amazon, you couldn't buy anything on Amazon that was made in China or put together in China? Well, Ford is a U.S. company, but a lot of the parts are made in China. And if China's not doing well, or General Motors, or how about chips, that may impact these companies tremendously, and they're already not doing so well. And used car prices are finally starting to come down. So right now, I'm a little bit bearish on Ford, General Motors, and let's give Tesla a few days to digest this news because it's still moving higher. But I'm definitely thinking of selling one of these three stocks. So I am bearish on these stocks, totally bearish. Now, folks, before I let you go today, boy, what a Friday, right? So keep your eye on the market. We may get a little bit of a reprieve. I'll go through the full seasonality for the coming week in the VIP room today. Don't miss out that session. It's happening at noon. And remember, subscribe, like our videos, subscribe to our Telegram channel, and post comments and feedback here. I pay attention to these things. I know if you're not posting them. Now, folks, my good friend and Chuck Hughes, he's about to expose one of Wall Street's best-kept secrets in a new way to potentially get ahead of the game. The way Wall Street invests is changing. Look at all the algo examples I just gave you, and moving all of its biggest transactions to a very specific time of day. And while they've kept the secret buried for a very, very long time, even years now, he's going live at 1 p.m., and I'm going to be there too. It'll be fun to reveal how the rest of us can target these power hour stocks. Join Chuck and myself 1 p.m. Friday Eastern Time. That's 10 a.m. What is it? It's 1 p.m. Eastern Time, 10 a.m. Pacific Time, 1 o'clock Eastern Time. Join us for all the juicy details, all right? You don't want to miss out. 1 p.m. Eastern Time on Friday today at 1 o'clock. If you don't know, if you can't find the link to register, go to the YouTube Wealth Press channel. It'll be right under the descriptor for today's video. You guys have an amazing weekend. Send me emails, support@marketgeeks.com. I want to hear from you. Have a great weekend. I'm back from Puerto Rico, and I ain't going anywhere for a while. Bye, guys. Have a great day. And be careful with these car stocks. They're dangerous right now.